Leaving your cash sitting in a basic savings account feels completely safe, but the actual returns are extremely tiny. To grow your money, your returns must mathematically outpace the rate of inflation, which steadily erodes your purchasing power. Building real wealth requires a consistent habit of regular investing. This strategy is more reliable than the high-stakes attempt to time a perfect stock market crash. To start, we will use this monthly setup checklist. You only need two things to begin: a clear personal budget and an active account on an investment platform. Transitioning from a passive saving mindset to an automated investing framework provides a mathematical path to keep your capital ahead of rising costs. Step 1 is establishing a concrete financial target with at least a 5-year horizon, such as a retirement nest egg or university fees. This chart shows why a 5-year minimum is necessary. Over long periods, the stock market historically offers higher potential returns than cash, providing the time needed to weather short-term capital risk. Once your goal is set, we check off Step 1. Step 2 is determining a specific, affordable amount of cash to commit to the market every month. This commitment is flexible. You can stop it, start it again, or change the amount you invest at any time if your financial situation shifts. You simply enter this chosen amount into the recurring investment section of your brokerage platform. Step 2 is complete. Defining a strict timeline and a flexible budget ensures you aren't locking up emergency cash while you build your long-term wealth. Step 3 is turning on the auto invest or direct debit feature to create a set and forget strategy. Automation removes the human element, preventing the emotional decisions that often lead investors to try and time the market. Instead of risking a massive lump sum at a potential market peak, you are putting money in through small, consistent drips. Step 4 is calibrating your strategy by selecting asset types that match your current stage of life. Younger investors generally target high-growth investments. As you approach retirement, you shift that strategy toward lower-risk, income-focused options. Automating your contributions while manually adjusting your risk level creates a customized financial machine that adapts as you age. Step 5 is the mechanism of pound cost averaging. This strategy functions best when you keep the automation running through market crashes. The stock market is always rising and falling. A regular habit irons out these fluctuations. By investing on a schedule, you buy at regular intervals regardless of price. When prices drop, your fixed monthly investment automatically buys more shares at a cheaper price. This mathematical reality removes the pressure of deciding when to buy, making it easier to stay consistent instead of panicking during a downturn. With Step 5 checked off, the system is fully configured. This strategy turns market volatility into a long-term advantage by ensuring you buy assets when they are at their most affordable. The system is now finalized. You have a goal, a budget, automation, a risk strategy, and a cost averaging plan. Over the span of several decades, those small, regular monthly amounts steadily grow into a massive, significant financial safety net. You have removed the stress of timing the market by consistently putting money in during both good and bad times. Stop letting inflation reduce the value of your savings. Set your financial goal, configure your automated plan today, and let time do the heavy lifting.